Hello, everybody, and welcome to Hash Rate. My name is Mark Jeffrey. My guest today is Lynn Alden. Lynn Alden is the author of Broken Money, Why Our Financial System is Failing Us and How We Can Make It Better. Hello, Lynn.
Hey, happy to be here.
So I loved your book, and I say this very often to people. Peter Thiel, in my opinion, wrote the best business book, 0 to 1, for startups. You wrote the world's best book for money. And I feel like it's on par in terms of excellence. So congratulations and thank you.
Well, I appreciate that. Huge compliment.
So I want to start for what for me was like sort of the most fascinating part of the book. And that is the moment where you describe the shift over from the usage of gold to Telegraph, or what I call Morse money, right? So sort of 1800s, you got everyone. Gold is what people think of as money. However, it's very hard to move around. It's heavy. When you move it around in stagecoaches, there's a lot of guys that are robbing the stagecoaches, stand and deliver, and you lose your gold. So that's bad. Then along comes the telegraph, and all of a sudden some very curious things starts to happen. So I'll let you take it from there.
Yeah, that was the core of why I wanted to write the book, because I actually resisted the urge of writing a book for a long time, because it can be a very tedious process. It's very, writing a book is a lot of work. And I didn't want to just write a book for the sake of writing a book. So for a handful of years, I kept thinking, should I have a book out? And I'm like, it's just I don't have that on my plate right now. But after just doing a lot of article writing and nonfiction research and everything, and kind of putting this together, this book kind of formed in my head. And then by that point, I couldn't not write it. It was too distracting not to write it. It was kind of distracting to work on anything else other than Broken Money. And one of the key foundations that I realized I wanted to focus on was how technology changes either what we use as money or how we interface with money. Because the vast majority of monetary history books focus on political decisions made by humans, and those are relevant for timing and the sequence of events. But in my view, there wasn't enough of them written from how technology itself gives us these underlying trends that then strongly affect what human decisions end up happening and mattering, and whether they're successful or not. And so one of the key things I wanted to focus on was how technology, in this case, especially the telegraph and later telecom technologies, completely changed how we interface with money, because it's almost like you can separate it into three eras. The first era of money, which literally went for thousands of years, was that transaction speeds were only marginally faster than settlement speeds. And that's because we have certain technologies that we don't think of technology today, like coinage, paper, and the printing press. These things allowed us to more easily verify an amount or more easily transfer legal ownership of something and move the thing under it a little bit less, or these things ease the speed of transactions. But there still was a pretty tight gap between transaction speeds and settlement speeds, because nothing could really move faster than humans on horses and ships and things like that.
Moves at the speed of gold.
Yeah, everything moved at the speed of gold, including the paper ledgers around it, even if they made it more efficient. And the telegraph opened up, and it was invented in the 1830s. It wasn't until the 1860s that it's going across continents. It's going across the Atlantic Ocean. By the early 20th century, it's going across the Pacific and linking the rest of the world together. So it's a process. But what started to happen was that was a whole new era in money history, because now transaction speeds were roughly the speed of light. Because if you can send pretty low bandwidth information anywhere in the world, then you can transact. You can make an IOU. And then you have a very slow settlement process of gold under it. One of the recent cases, not that long ago, literally within the past decade, Germany repatriated a lot of its gold. Yes. And I think they estimated it would take 7 years. It took 3 or 4, so it was faster than schedule, and it cost millions of dollars to do it. And it's it took you years and millions of dollars to repatriate.
That is so crazy.
Yeah.
I know. Because when you say settlement, you mean moving the gold from one bank to another bank. That's settlement.
Yes. And securely and fully legally audited and everything. They're sure that it worked properly. They're sure that they got the right amounts in the right level of quality, level of precision. not like fake bars, not the wrong kind of bars, not the wrong amounts, that it never lost chain of custody. That process took years. And even if they've said, okay, we'll make it faster, we'll do it in months or weeks, it's so costly and burdensome. And one of the things I focus on in Broken Money is that when that gap created, where all these transactions are now moving around the world at the speed of light, it completely detached the transaction speeds from the settlement speeds, and that gave a lot of power to the middlemen that were running the ledgers. It basically gave a lot of power to banks and central banks above and beyond what was possible in the prior era. So it kind of changed the incentive structure of money and led to all sorts of issues that we have today.
Yeah, well, I think you said something really interesting in the book where you basically, so we move into this new era where we got the telegraph and all these bankers are like, hey guys, instead of moving like the actual bars of gold around, why don't we just telegraph each other IOUs? And, and then we'll just keep ledgers on all sides to make sure we're all being honest. But the interesting thing I thought was the IOUs then replaced the gold in people's minds as the most useful form of money. And in fact, became more highly regarded in some circles than the actual gold itself. So that was sort of point A that was interesting. And then you talk about a guy in London who's like just figuring out, like, he's sort of like, holy shit, if this Telegraph IOU thing takes off, we can control the flow of money around the world. He's getting all excited about it because he's basically realized that he's got the one ring for money, right? He's like, I will have the ring that will control all finance. And I forget who the dude was, but he got super excited about it. And he turned out he was right. Right.
That was my favorite source in the book. So that was William Stanley Jevons, who's the same person who we know of as Jevons paradox.
Yes.
But this was a different subject. And so in chapter 8, I really focus on the transaction versus settlement speed mismatch. And that chapter, because it's one of the 2 or 3 core points of the book, it has to really hit hard. And I felt like that chapter just wasn't quite, it was fine, but it wasn't like amazing. And late in the, writing and editing process, I came across this book from 1875 written by him, and it was kind of the version of Broken Money at that time, like 150 years prior, because he's talking about how technology affects money.
Yeah.
And he was talking about like literally the nuances of coinage, the nuances of banking and stuff. And then at that point, the cross-Atlantic telegraph had been out for about a decade. So he's right up front. And he's like talking about how there's this big flow of trade between the U.S. and the UK, for example. And he's like, it would be absurd if there were 2 streams of gold specie just like flowing back and forth across the Atlantic at all times. That how immensely inefficient that would be. He's like, clearly we want to net this as much as possible. And then you can have a practically infinite amount of money moving around on gold that hardly ever physically changes hands. And he's like, this is marvelously efficient. And he's like showing all these nested ledgers. And he's like, first we centralize, like if I want to send money to you, we just have to have a bank that can make that super easy. If we happen to have different banks, we need our banks to be able to talk to each other. If there's a whole bunch of banks that are kind of inefficiently talking to each other, they can just go on one big central bank. And if there are a bunch of central banks around the world that are all talking to each other, they could all just centralize in London, which in his day was the financial center. He's like, so we have 4 layers, we just fix everything, and it's hyper efficient. But then the best thing he did was he's like, this could also be disastrous. He's like, this is so efficient that he's like, if you look at UK right now, and this is in 1875, he's like, it's levered 20 to 1. Like if 5% of people want their gold back, they can't have it.
Right. Let's talk about that for a second, because I think that's a key point. And I think for people who haven't studied finance or played around with DeFi, there's sort of like this thing that happens where your money the dollars in the system can sort of be in more than one place at the same time. So if you have one gold bar, let's say it's $100 worth of gold, right? Then I send an IOU to you, and that's now in your bank. But I don't send the actual gold. And then now you've got $100 of my IOU. Now you send an IOU to somebody else. Now that like $100 is in actually 3 places at once, sort of, right? I got that right? So that's where the leverage comes from. That's how it happens, right?
Yeah, more or less. I mean, another way to put it is that banks rely on a mismatch between liabilities and assets. And so they're in their mind, they're not committing fraud by just copying it, but they're basically saying, look, we have this much gold. we have this many accounts, like IOUs for gold, and we have assets backing that, but not all those assets are gold. Some of those assets are, for example, a loan that you've given out to someone, and they have to pay you back gold. So a bank could say, "Look, we have our liabilities 100%, 110% backed by assets, but only say 30% of that is actual physical gold in our vaults, and the whole rest of it is gold denominated assets." And so any individual bank is doing the math and saying, well, what are the probability that 30% of our customers want gold back at once, right? So we're probably okay. Of course, until you run into like an edge case, and then it turns out every single bank is highly interconnected and the thing's levered 10 to 1 or 20 to 1, and then it all breaks. And so when Jevons was talking about this, he's giving all these quotes describing exactly how it could be disastrous. And then something like 40 years later in World War I, it just all completely broke, just all of it.
Well, you make another. So you bring up World War I. I thought this was also pretty interesting. Previous to this system of Morse money, this telegraph money, wars were contained by the amount of gold that was available, right? So the kings and the presidents, they couldn't wage war past a certain level because they just didn't have enough gold to sort of pay all the soldiers and buy the war machines. But now that we had this highly leveraged environment, all of a sudden everybody could fight everybody, and it was affordable, and that was called World War I. And you make the point that World War I probably could not have happened without this telegraph money being so prevalent. Is that right?
Yeah, if you look at the history of World War I, it's kind of like trivial how it started and then to what we know it ended up as. And of course, that cascaded pretty directly into World War II. So it was all kind of like two parts of one war. And prior to then, governments did debase. I mean, we're all familiar with like Rome, like slowly debasing its coinage. But this was a very physical process. If you wanted to debase coinage, you'd have to tax the coinage in, remelt it, reissue it, and kind of benefit from that, as well as like your normal taxation approach. And so there's like a speed limit on how quickly debasement can happen, especially at massive scale. And any sort of fiat currency experiment, like some of the paper currencies in older China or John Law and some of these things, they didn't last very well because the tech just wasn't there for it. If you're given the choice between a gold coin and like a paper in a world where there's no telegraph or anything, you want the gold coin. And what kind of World War I did was we're at the point where we're in a telegraph world now. Speed of money matters. Everything's levered 20 to 1. And the UK literally went out and said, okay, we're not even involved in this war, but we have certain allies we'd prefer to win over other countries. So we're going to try to get in this. And then you have to convince the people of the UK that we want to, finances us. So we're going to issue war bonds. And you guys buy the war bonds and we'll go ahead and win this war that's not even in our country and XYZ. And they only got like a third of the war bonds covered. Not that many people wanted. They didn't look at that as a good investment. And so instead what the UK did was lied and said it was oversubscribed, but really they just printed they worked with the central bank. They printed the money out of nowhere. And the power that gives them is they're basically invisibly taking money from everybody's savings, whether they know it or not, and channeling it toward war. And then because the UK was the global reserve currency at the time, they're not just stealing British citizens' money. There's countries around the world, including like colonized countries, holding their like sovereign assets in UK, securities. They're just completely getting rug pulled quietly and then found out in the years that followed. And so what that capability did was it gave countries the ability to not just like tax and spend or borrow and spend. They could print and spend, and then all the households find out a couple years later that they all got rug pulled.
God, that is so crazy. I forgot that part of the book, but yeah, they actually completely faked the war bonds. It was a big failure, but they just covered it up and printed money and didn't tell anyone. And oh my God. So, and then, after those two wars, after World War I and World War II, fast forward now to the Vietnam War, and the U.S. had spent a ton of money on that. And then, what happened in 1971, we've all seen the website in our feeds, right? And that's when Nixon pulled the United States off the gold standard. And now gold did not back the United States currency. It was full fiat. Just it was worth what it was worth because that's what the government said it was. But then also we made it sort of this utility token for the Saudi oil app, right, to sort of create artificial demand for it, right? But I believe that the reason why we came off the gold standard was in part to pay for the Vietnam War. So again, there's that war connection, right? Did I get that right?
So yeah, that was a big chunk of it. There was the fiscal issues, but then they're also going back to the fractional reserve bank lending aspect. So that all these like asset liability duration mismatches. All the banks in the system now, they're not backing their dollars by gold. They had a very indirect gold backing, which was the central bank and the sovereign would ostensibly back some degree of its currency with gold. Banks, their base layer was just denominated on the Federal Reserve's ledger, and that they would make these lending decisions, and there'd be way more broad money than there is base money, and way more base money than there is gold. And what happened was, from say 1950 to 1970, the money supply tripled, while U.S. gold reserves got cut in half because of gradual redemptions by foreign entities. And we reached a crossover point in the very late 60s where like our IOUs outstanding internationally, because at the time Americans couldn't redeem dollars for gold, but like international like central banks could. Like that's kind of what kept it semi credible. And it got to a point where we had so many IOUs, even to external foreign entities that actively could redeem it, that we crossed over a pretty clear breakover point, and it was just no longer sustainable because they didn't set it up in the first place. So a lot of people focus on errors that were made in 1971, and the book kind of covers like no, these errors were made when the system was designed. It just wasn't there was no tether between how many dollars can exist and how much gold there is in the system. And so yeah, that whole thing broke, and then the way they salvaged it was because in this world, speed matters, because now you have not just the telegraph, you have the telephone, you have the radio. We're on our way at that point to like an internet world. Everything's super fast, and treasuries and dollars are just way faster than gold. And like, yeah, you point out that they had like basically made it utility tokens for petrodollars, and there already was the existing euro dollar system, which is a fancy way of saying offshore dollars. And so the combination of the existing network effect plus intentional efforts to make it a utility token and keep it the network effect going strong basically supplanted gold with dollars. And in a world where people were like, okay, dollars aren't quite as sound as gold, but they don't grow in supply that much faster, especially when adjusted for interest rates, and they're way faster. So all up until then, anytime two commodity monies ran into each other, the harder one to make always won out. So if shells run into silver, silver wins. If silver runs into gold, eventually the gold would win. And this is the first time where, say, gold and dollars ran into each other, and the softer one, dollars, for a multi-decade period, pretty much won out because this was the first time where speed mattered.
Yeah, and then so then bringing it back to Bitcoin, and I should point out that your book is very careful not to be a Bitcoin cheerleader, right? Like it's not a Bitcoin book; it's a money book, and some of your conclusions lead to Bitcoin. You're critical as well as supportive, kind of fairly even-handedly, I have to say. So, compared to some other books, which are just clearly Bitcoin cheerleading, and that's it, right? So, but you do bring up that with the advent of Bitcoin, you're no longer in a world of IOUs. You're actually dealing with the asset itself, Bitcoin, which is a new form of gold in many people's eyes. And when I own a Bitcoin, it is like Morse money in that it moves at the speed of light, and yet it is also the actual asset, not an IOU for the asset itself. We're talking about auditing Fort Knox now because we don't know what's there. Nobody knows, like other than whoever runs Fort Knox, whether that gold is still there. With Bitcoin, we know anyone can go look at the wallet and see if the Bitcoin's actually in it, right? So, so talk a little bit about, does Bitcoin solve this broken money issue, and in what dimensions does it solve it? What dimensions does it not?
I think the key thing that it starts to solve is that speed mismatch between transactions and settlements. So I mentioned 3 eras of money. First era is everything pre-telegraph. Next era was basically everything from the telegraph until 2008. where you have fast transactions, more money, but you don't have any fast settlements. And so you're reliant on basically centralized ledgers in the meantime. And what Bitcoin represents is the invention of fast settlements. So for the first time, you can send final value to someone in a way that is not reversible and not based on some IOU, roughly at the speed of light. Maybe not literally, but you're only minutes behind. And so that gap is now closed by orders of magnitude. And that opens up a whole third era potentially of money, where you decrease the power of those big centralized ledgers. And there are still limitations. One thing I describe is that people that don't study the prehistory of Bitcoin often think it's just this thing that came out of nowhere, but there actually was all these puzzle pieces falling into place gradually about as early as they could. So David Chaum was talking about this concept in the early 80s with his dissertation, basically how to build a ledger that could be managed by mutually suspicious parties. That's like the prehistory way of saying Bitcoin. And then there was, Adam Back and others were looking into how to create proof of work for spam prevention, things like that. Nick Szabo talked about BitGold. How can we take the proof of work concept and make a kind of finite digital currency with it? Hal Finney took that concept and made reusable proof of work tokens, with the limiter being that they were reliant on a centralized server, even though there was work going into each one. And so he didn't quite solve the decentralization problem, like with the difficulty adjustment yet. So then Satoshi came out, and he's the one that put all the pieces together. In addition, SHA 256 was published in 2001. Global internet speeds were just kind of reaching the point where something like Bitcoin could function. Like when Satoshi published his initial mailing list white paper and everything, everybody except Hal Finney was pretty much very critical on that mailing list. And the biggest objection was bandwidth. Like you can't do this at scale. And so one of the things I point out is that Bitcoin came about as early as it could have. So it's way harder to do digital settlement than digital transactions, because you need for transactions you only need Morse code, whereas now we need all sorts of more complicated cryptographic structures, decentralized ledgers, way higher bandwidth to move all that around. But now that we have it, we're in this third era of money. The limiting factors are you still can't have rapid digital settlement that's decentralized at infinite scale, right? Because if everybody had to store every email ever sent on their computer, that'd be grossly inefficient. Same thing for and like, do you want your coffee transaction to be like a mutable part of like human history now? Like probably not. And so ever since then, there's been this whole 16-year endeavor. How can we layer this? How can we optimize this so that we preserve base layer decentralization while having obviously more throughput? And I think that's still one of the biggest challenges today. There's other ones like, how do you navigate the transition into maybe where you need quantum resistant encryption types? There are still bottlenecks ahead. But it's foundationally, it brings us into the third era of money.
You bring up quantum, and I do want to talk a little bit about this, because this has been more and more on my mind. And looking at your posts on X, I believe it's also on yours. Chamath Palihapitiya said that he believes that we're somewhere between 2 and 5 years of quantum possibly breaking Bitcoin. My guess is that it's probably further out. But my other friend, Fred Krueger, brought up a very interesting point where he said, even if we do get quantum resistant addresses tomorrow, it's going to take at least a year for all the wallets on the Bitcoin blockchain to move to the new quantum resistant addresses. You got to move your money from one wallet to the other, right? So even if there were no other transactions other than just people upgrading, it would take a year. So that's not going to happen, right? Because there's always going to be other transactions going on. So call it 2 or 3 years for the full upgrade path, barring another method of doing this. So it may be closer than we think, and it may be less feasible than we think to upgrade for quantum. What are your current thoughts on that as a threat to Bitcoin overall?
I think you summarized it well. So I think it's feasible, but the timeline is relevant. And I would actually say, I mean, from estimates I've seen, it would take more than a year to transition them all. So it's not something you want to. It's not like quantum computers capable of doing this can come out and then we go ahead and start working on the problem. Like you generally want the problem to be somewhat solved in advance of that. There are, of course, challenges with quantum computers. Like you have to have way more of those types of bits because there's so much error correction that goes involved. But functionally, when we're looking, 5 years out, I mean, I think it's people used to say 10 to 20. I mean, I had classes back in college and we were talking about quantum computers, and many of us thought we'd probably start to have them roughly by now. So, these things can take time. But there are known solutions, like there are known BIPs that can do the transfer. I do think that they're worth looking into and kind of prioritizing at the current time. One of the mitigants, though, for that whole list of things is early quantum computers, even when they are able to start cracking Bitcoin, it's still costly to do so. Like it could cost $1 million to reverse engineer a public key into a private key quickly enough. And there are this gets a little bit technical for my level of understanding, but there are also differences between, like, if you send money to an address that's never been sent from, you're more safe because a quantum computer has to try to crack your public key during like a block transmission process, rather than just the public key's out there, it's known and has all the time in the world. But the issue is, so let's say a quantum computer takes $1 million worth of computation to quickly break something of value. That means basically every UTXO over $1 million is at risk. And so in that time frame, maybe not every $1,000 UTXO has to make the transition, because even when it could be cracked, it's not economically efficient to crack it. So there is still that gives us more time, because the whales are going to have to move over, and the exchanges and the custodians and all that, they've got to move over before that quantum is ready. Smaller users potentially have more time because it's very inefficient to attack you. But it's hard to speculate ahead of time. Okay, once we have the first quantum computers that can do this, how long until they're 5x or 10x better or 100x better? And then you start putting the whole chain at risk. So I think there is time, but I don't think there's like time. I think you should be taking it pretty seriously.
Yeah, I feel like I feel like Bitcoin Core is not taking this seriously enough, and I could be wrong because it's not like I talk to those guys every day, but it feels like this should be a Manhattan project, especially given how neck deep the United States is getting in Bitcoin, as well as states and other state actors. The fantasy world that we all sort of hoped would happen, it's starting to happen, the hyper Bitcoinization. But with this threat looming over it, I feel like we need a Manhattan Project level of assault, a startup level solution in play, and I don't feel like we have that. And I'm a little bit disturbed by that. So,
I think there are people working on it. I would like to see it start to be accelerated. And then there's other challenges too, like quantum resistant signatures take more space. How does that affect transaction throughput, for example? And then also things like, okay, so should there be a certain time frame where if people did not migrate their coins, should those coins be locked so that they're not just like permanently hackable? But then you're arguably censoring the Bitcoin network.
right.
But then the counter argument is, well, if you haven't moved your coins in 5 years, it's kind of evidence that no one actually owns their coins or cares about those coins.
Like the Satoshi wallet, for example.
Yeah, and it's like, would you rather be locked or all owned by North Korea? Is kind of and or Google, and then what do we do with that? So that's kind of one of the other. So there are like multiple controversy points in addition to just the time frame. So people have to figure out what's the cleanest technical solution, how quickly to settle on it, consensus wise, and then what do you do with the addresses that don't change over, and what do you do about the fact that signatures might be longer?
Yeah, there's a lot of things to think about there. Okay, let's move on to our current dollar system. So one of the things you said was you had one point in the book where you describe it all, and you said, if right about now you're thinking it's turtles all the way down, you're right. It's turtles all the way down. And by that you mean that the entire system is sort of circular. Everything is it's basically ultimately backed by itself, which is to say backed by nothing, right? Because if you're just backing yourself, that's not a real thing, right? So, one of the things that sort of shocked me when I started sort of picking apart how our money works, because I'm not a person who thought much about money until sort of Bitcoin came along. I just assumed, there's dollars and they, more or less work. And yes, there's inflation, but it's not really that big of a deal. And then once I realized, the United States government, when it borrows money it doesn't print money, it borrows money, but it does print the interest that it pays off to the people who are borrowing. And the borrowing is done in the form of treasuries, right? Well, there's a couple different ways, but you basically give them you give them your money now, lock it up for a year or whatever, 5 years, 10 years, and you make at the moment more or less 5% annual interest on that. That 5% is then printed later by the government to pay you off. But basically it's just sort of it's sort of a Ponzi scheme, right? So. Elon recently said, I found 14 magic money machines. I'm like, wait, there's a lot more than that. And then I found out that, I found out about fractional reserve lending, how the banks could lend out 10x whatever they had on hand. Then after COVID, they just got rid of the fractional reserve part and said, screw it. You get to load out whatever you want. So every bank, when it makes a loan for a house, it's just printing the money more or less to make that loan. And so this system, it feels very crazy. It feels like just a very, very big, very, very old Terra Luna. Am I right about this? What did I describe this correctly? Is it as insane as I think?
Yeah. When I criticized Terra Luna before it blew up, I compared it to like an emerging market central bank without a monopoly over any jurisdiction. So it was like you're trying to do without even some of the advantages they have, and let alone a developed country. You're talking Europe or the U.S. So yeah, it's not to that degree per se, but it is like there are rules that slow it down. So it's really hard to just print $1 quadrillion tomorrow, for example. There are these kind of rules, and there's kind of like certain checkpoints where like a multi-sig is needed. Like not one person can just do this, but instead there's a handful of entities that all kind of have to agree. And for example, during the pandemic, that was unlocked for a period of time where it was easier to just print trillions of dollars because there were multiple parties that were willing to do it. Same thing for the 2008 to kind of 2014 period, the global financial crisis and the aftermath. There are certainly these unlocked periods where they print money. And the way that it kind of works is that there's different entities that have jurisdiction over different areas. So a commercial bank, effectively, whenever they make a loan, they're printing money. They have to comply by certain liquidity regulations and certain capital regulations, and then self-imposed regulations if they want to risk not blowing up, like make sure they're not like first in line if there's like a big problem. They'd rather have other people go down first and then everybody gets bailed out. So commercial banks, if they print money, at first it's limited to them and their customers because their liabilities, like their deposits, are backed up by assets. But those assets include base money. It includes things like treasuries, and then it includes things like loans. So like if I owe a mortgage to my bank, that's backing up some of the assets in the deposits. But at the end of the day, there's way more broad money, so way more deposits than there are actual base dollars. And the entity that controls how many base dollars there are is the Federal Reserve. And during emergencies, they can get their multi-sig open, and they can create more base money with the results that come from that. But there's some resistance to doing that too quickly. Obviously, they have certain mandates and certain laws, and a certain number of them have to agree. And then you say, well, what is the Federal Reserve's base money backed by? Treasuries. So what are treasuries? They're IOUs for dollars. So that's what I mean by it's circular. It's basically this circular process. It's kind of backed up by multi-sigs and backed up by just various frictions that try to slow it down. And when people talk about like a developing country, or the negative term would be like a banana republic, like there's not enough kind of rules in place that would decentralize the process of money printing fast enough so that they're more prone to like these opaque, rapid increases in the money supply, more prone to hyperinflation, things like that. Whereas generally in places with stronger institutions and a little bit more decentralization, or just a little bit more sophisticated management, there's ways to slow that down, so that we get debasement, but we don't usually get rapid debasement. And that's what keeps the system credible enough that it's been working for decades, with winners and losers along the way.
So if people stop buying treasuries, so basically the whole thing keeps going and it's fine so long as we always have more and more people buying treasuries, because that's sort of the engine that keeps the wheels spinning, right? So in a collapse, at a certain point, there's going to be people who say, I don't really give a shit about getting 5% on my dollars, because I don't think dollars are going to be worth that much in 5 years or 10 years or even 1 year. And at a certain point, they make the calculation, I'd rather put my dollars into real estate or Bitcoin or gold rather than 5% more dollars, right? Like that's how a collapse could happen. Are we seeing that now with other nations stopping buying our debt? Because I've seen a chart where it looks like they've at least slowed down their purchase of our treasuries. Is that in fact what a collapse looks like in slow motion?
I think we're still a whiles away from that. I'd say for your first question, I think it's right. The things that generally lead to a complete collapse in a currency is people lose faith that it's going to those things that, like that multi-sig I described, that kind of slows down the process of money creation. When people lose faith that that's working or that that's still there, and that they don't, it can just increase so rapidly, then they don't want to hold it, and money becomes a hot potato. There's very little like monetary energy stored anymore, because nobody wants to hold deposits or bonds any longer than they have to. And that's how you get a rapid unraveling, because then they have to just print the difference, and then it becomes self-reinforcing and just hyperinflates. The U.S. dollar is different in a couple ways. So one, it is true that the foreign sector is not really buying treasuries. For the past 12 years, like something like 2013, China said it's no longer in their best interest to keep accumulating treasuries, and they've been true on their word. They've instead accumulated loans to the rest of the world for their Belt and Road Initiative, basically. Now the foreign, like non-central bank sector is still gradually accumulating treasuries, but not at the rate that they're being issued. And so the foreign sector owns a smaller percentage of treasuries. The other big factor, though, is that the world has something like $13 trillion worth of dollar-denominated debt. And it's mostly not owed to the U.S. It's like, because it's the global ledger, if an entity in France lends to an entity in Brazil, it's often in dollars. And so a Brazilian entity, either the government or a corporation, owes some entity in France dollars. And that represents inflexible demand for dollars. And so that is a built-in, it rapidly slows how quickly debasement can happen. So, and part of the phrase I like to use is nothing stops this train. And what I generally mean by that is fiscal deficits and money supply growth are going to keep happening structurally, but that they're not going to happen so quickly that because if you unravel, the train stops. And so I think within an investable time horizon of 5-10 years, going into the mid 2030s, I think it's a very gradual, ongoing debasement process where we're not going to hyperinflate in that time, but we're also not going to have austerity or really slow down the money creation process, in my opinion.
Okay, good to know. Okay, let's talk about what Trump and Elon are doing, and I'll give you sort of the summary, and you can correct me if I get this wrong. But bottom line, we spend as a nation, the United States spends $7 trillion per year. If we're a company, so that's our spend. We make $5 trillion, so we're basically losing $2 trillion per year. Doge is looking to cut $1 trillion, possibly $2 trillion, which would sort of bring our spend and our make about even. So we'd at least be treading water. We wouldn't be bleeding anymore. But we're also looking to make more via tariffs and, selling gold cards. Who knows? We're going to be able to sell a lot. But, some people are saying that could actually be trillions in revenue. We'll see. Do you think, first of all, Elon Musk has also said that we're going bankrupt. Sounds like you don't think that that's the case. So whatever's going on here, we're not in as much trouble maybe as, sort of being panicked about us going bankrupt. It sounds like from what I'm getting from you, that's not where you're at. But I guess my question is this: are Trump and Elon more or less doing the right things to fix our money as much as it is fixable in its current state?
I think a lot of the intentions of what they're trying to do are correct, and I think that we are going bankrupt in slow motion, right? So,
Yeah.
I don't think it's not like this year's a big deal compared to 5 years ago, but certainly ever since 2020, it's accelerated to some extent, and so when you look out far enough, it becomes a major issue. Like, for example, the Social Security Trust Fund, it runs out in the 2030s, which, if left unchecked, would mean that Social Security recipients only get like 70 cents on the dollar, because they can only fund it by their current tax revenues. So you either have to substantially increase everyone's Social Security contributions, which would be unpopular, or you cut everyone's Social Security receipts, which would be unpopular, or you means test it and say, above a certain threshold, look, I know you paid into it, but you're going to get 50 cents on the dollar so that other people can at least get 90 cents on the dollar. There's, that's the debate that would happen at that point if this is left unchecked. The challenge is that most of the spending growth is from things like Social Security, Medicare, defense, interest expense, veterans benefits. Those are all very hard things to cut for a bunch of different reasons. The much smaller share of spending is like the long tail of everything else. So on the pie chart, all the stuff that actually millions of like federal workers are like actually employed to do, like the big spending areas, especially like Medicare and Social Security, like almost nobody works there, and yet that's where trillions goes because they're mostly transfer payments. Whereas all the little spending programs that everything else is involved, that's a much smaller share of the pie chart. And so my kind of assumption and estimate is that they're going to keep racking up a lot of optical wins. Like, hey, we cut this random thing about turtles in Wyoming. We saved you $1 million. And you'll get a bunch of those. But it's really hard to make $1 trillion dent. The other complication, and this is a big thing that the Trump administration is focusing on, is because the dollar is a global reserve currency, it means there's extra demand for it. Because everybody in the world that's operating with either dollar-denominated funding, like liabilities, or making international contracts in dollars, basically needs dollars. That gives the dollar a bigger monetary premium than other currencies. So we tend to trade above our trade like balance approach, which gives Americans more import power and makes our export competitiveness lower for lower margin goods like manufactured goods. So we supply the world with dollars they need through structural trade deficits, which we've been doing for like 50 years. And after like decades of that, it's become extremely imbalanced. So you have on one hand, you have the Rust Belt, which the name implies basically this our industrial base just rusted out, stopped growing, basically went flat, went down on a per capita basis. It all kind of got replaced in China and elsewhere, to the point where now it's a major political issue. Now it's potentially a national security issue. Like if the Pentagon can't make missiles as fast as country XYZ, that's a national security issue. Or the supply chains, if 40% of the chips they use are in China, and sure you could replace any one of them, but could you replace 40% of them in a given time frame? That's a much harder ask. And so those start to become increasingly prioritized. So one of the things the Trump administration is trying to do is change the structure of trade. And I think that's a noble goal. We'll see how successful they are. There's certainly like he's got Stephen Miran, his nominee for Council of Economic Advisors chairman. He's got this whole paper. It's like a Harvard economist. He's got this paper about if you were to adjust the trade system, how would you do it? What are the risks of doing it? So behind kind of the headline of, hey, we're going to tariff this country 25%, we're going to do this, and there is like an intellectual rigor that's also going on, at least as part of the administration. So I think some of those approaches make sense. One of the biggest risk factors is the U.S. is very financialized, which means our tax receipts are heavily correlated with our asset prices, more so than most other countries. It's a bunch of reasons went into that. And so let's say you did increase austerity and let's say you did do a lot of tariffs and got revenue there. So let's say you did start to cut the deficit by, maybe 500 billion a year. It probably wouldn't be great for asset prices, and then with a lag, it wouldn't be great for tax receipts. So you might cut the deficit by 500 billion, then you might get 200 billion less in tax receipts, and so you only cut it effectively by 300 net after all that work and all that pain and voters that are angry at you and nations that are. So now it's like was that how effective was that? And so the problem is it's kind of a Gordian knot that's really, really hard to untie, regardless of who's trying to untie it.
Yeah, I'm sort of. It's a complex issue, but I feel like, and I hear everything you just said, but I feel like from my own perspective, and I'm not anywhere near as much of an expert on this stuff as you are, but it feels to me like since sort of the 80s or the 90s, Ron Paul and other people have been sort of more or less banging the drum, saying, "Look, we got to do something. We got to do something." And there's just been sort of this endless parade of people from on both sides of the aisle who've more or less done nothing. And it feels like, maybe it's imperfect, but it feels like we're at least for the very first time, from what I can tell, making attempts to, we're taking hacks at the Gordian knot. We're not just going, oh, screw it. It's the Gordian knot. Nobody can ever untie it. Ha, let's run away. We're at least stabbing at it, maybe with a butter knife, but we're at least taking some swipes at it. So
I agree. And I think two main things happen. So one is, so the peak zeitgeist for the public debt was in the late 80s and early 90s. So in the late 80s, the famous national debt clock went up. And in the early 90s, Ross Perot ran the most successful independent presidential campaign basically ever, or in modern history, based on debts and deficits and a couple other key things. And what happened after that was interest rates went down a lot. Soviet Union collapsed and opened up to the world. China opened up to the world. That was pretty disinflationary because we took all these Eastern labor and resources and all this Western capital and put it together. And so that kind of delayed the interest expense problem. And it kind of blew out our trade deficits. So what happened in the past, say 5 years, and is that we basically hit zero in interest rates. And so we no longer had structurally falling interest rates offsetting our ever rising debts. And so interest expense actually started to rise meaningfully again. So that's one really big catalyst that woke a lot of people up. And number two was every year when we're running structural trade deficits year after year after year after year, it's cumulative. Back in the 80s, 90s, and 2000s, there were some people saying, "Hey, you're literally causing us to have a rust belt." But then the other people in New York saying, "Oh, this is great. We're booming. Look at everything's going up." So the votes were not there really. But now we reached the point where, and we saw this in the elections, the Rust Belt swung from red to blue. I mean, blue to red. It swung to the people talking about the trade deficits, at least around the margin. And so we kind of hit a pendulum swing there. And I think those are the two really big things that actually, to your point, they are starting to hack at this with some sort of knife. We'll see how effective it is. And the only challenge is I think because it's a big enough multi-year problem, like a multi-decade problem that got us here. It does take probably multiple tries, multiple attempts to do it. Kind of like how in Trump's first administration, they didn't really make a dent in the trade deficit. This is a second attempt coming in with harder, faster, shock and awe. So they are ramping up their approach. And it's a hard, long range problem.
So earlier this week, we had a little exchange on X where I forget how it started, but I think I was ripping on Bitcoin Lightning, and you came along and said, "Hey, Mark Jeffrey, let me make you use Bitcoin Lightning, and I'll send you some Bitcoin." And I said no a couple times, and finally I said yes, and which you forced me to have another look at it. And so I'll let you first of all describe what Bitcoin Lightning is, and then we'll talk a little bit about what the experience was like.
Yeah, so we talked before in this chat about how one of Bitcoin's limitations is throughput. If you're going to have a decentralized system, you have to have some degree of layers or other solutions to basically make it so that what is effectively like billions of transactions can settle down onto fewer transactions. One thing is if you look at FedWire in the U.S., it settles, and it's a comical number, but it settles about $1 quadrillion a year in gross settlements, so $1,000 trillion worth of annual volumes, and it does that with about 200 million transactions a year, or about the throughput of the Bitcoin network. And so the whole U.S. and big chunk of global fund flows are happening on this centralized ledger that's got about as much throughput as Bitcoin. But the difference between that, the average transaction is like $5 million for FedWire and is lower for Bitcoin. And so if Bitcoin's going to scale, there's some degree of layers that have to kind of help you settle more, like, batch transactions onto the base layer. And one of the less popular ways, I mean, it's popular in numbers, but not in kind of concept, is custodians. Any custodian is effectively a accelerator or scaling layer. So, for example, in Cash App, you can send Bitcoin to other Cash App addresses, and that's Cash App, running their ledger on top of the Bitcoin network. And of course, it's centralized and it's prone to regulations and prone to a public company that's audited, maintaining soundness, which we have to trust. And they can do proof of reserves and things like that to build trust, but it's a permission layer. Then there's other layers that can work alongside that, or kind of as the middle layer of things like Lightning. So let's say Cash App wants to settle with Wallet of Satoshi. They could be sending Bitcoin transactions back to whenever one of their users wants to send money to each other, or they can just have a big Lightning channel open with each other and use that for 100 transactions, and eventually refill their Lightning channel once they've run out of liquidity in one of the directions. So I think,
wait. Let me just break that down, because I think a lot of people didn't follow that. I know. Sure. I wouldn't have without digging into it. So so basically, Lightning, it operates more or less instantly. So you don't have that 10 minutes that Bitcoin takes.
Yeah.
So it's called Lightning. So I assume it's lightning fast. So it's like a couple seconds at the most. And when you say open a channel, it's not like a blockchain where it's not a blockchain. So Bitcoin Lightning is not a blockchain. And in fact, stuff does not even travel over the Bitcoin layer itself. As you say, it's another thing bolted on top of Bitcoin. And when you open a channel, what is that and how does that work?
So that's basically a set of pre-signed transactions. You can think of it as a 2 of 2 multisig opens up. Okay. And so if we were to open up a channel with each other, and I put half of Bitcoin on one side, we now have like equivalent of an abacus between us. So like a bar with a bunch of little beads on it. And every time I send you Bitcoin over it, I transfer some of those beads to your side. And either of us, like we can both agree to close the channel. We each sign our key and say, okay, we agree that the number is what it is. Or if one of us tries to do like improper transaction, or just otherwise wants to close the channel, we can do a unilateral close. It takes more time because there's like certain time locks for things like that. And that channel can be closed with whatever the current accurate balance is. And then the cool thing is, if we had a third person here and you had a channel with them, and I didn't have a channel with them, but I wanted to send some of my beats or some of my Bitcoin to them, I could send them through you to him, with you taking a tiny routing fee in the process. And so the Lightning Network is basically, technically there's more than one Lightning Network, because any two people or any two entities can have their own unconnected Lightning channel. Now that'll have somewhat limited use, but they can still do it. In practice, the Lightning Network, the bulk of it is this big interconnected set of channels, with some channels that act like more like hubs, and they can come and go depending on how they're operating, and a bunch of people on the edges that are using that in either non-custodial ways or custodial ways.
So it's almost like a Telegraph network that's built on top of Bitcoin, where we have Morse money in our Telegraph, the Lightning Network. It's almost like that, right? But once I get the actual message when I actually get it on the abacus on my side, I can then redeem it for real Bitcoin, right? So, and how does so when I received my Bitcoin from you on the Lightning Network, I use Strike, which is an app that you can download, and that makes it easy to get. You can't just use your Bitcoin address as your recipient address. You need a Bitcoin Lightning address, and Strike provides you with a Bitcoin Lightning address and makes moving from Bitcoin to Lightning and back again, bridging, if you will, to use sort of Ethereum speak, makes that very easy and it abstracts it away from you. But how does it normally work? What is the process between going from a Lightning wallet and a Bitcoin wallet usually like outside of Strike?
So outside of Strike, you would generally be, there's a couple ways to do it. One, there's like a hybrid solution where you use what is effectively a Lightning service provider, where you're the one that has the keys to your channel. So it's non-custodial, but you're relying on the other side to basically provide liquidity and to obfuscate the technical details away from you. And so generally speaking, on average, you'll find that experience a little bit slower, a little bit more prone to friction, occasional like fees for opening and closing a channel in exchange for being a little bit more cypherpunk. Like you have, more privacy, you have more control of your own funds. For working capital, where, and this is what I generally find is that a lot of people talk about, can we make every transaction in the world completely self-directed, self-custodial? Probably not. There's bandwidth limits. But then again, it's like when I walk out in the street, I have dollars in a wallet that is prone to mugging or loss or things like that. And I wouldn't put my life savings in it, but there's certain thresholds that I'm comfortable with. And that's how I think we look at custodial Lightning wallets, which is to say if you use one, it can be hyper efficient. But eventually, if you have too much working capital in it, you probably then want to send it out to yourself self-custodially or with a really reliable vault of some sort. Go ahead.
Yeah, I was, so from my experience and sort of looking, I did some research on it after we had our little interaction. Bitcoin Lightning looks like it's pretty good for transactions that are about 5K or less. But if you start, if I'm trying to send like 100K around or even 50K, it doesn't work so great, or it just refuses to send it because a lot of the intermediaries, there's not enough liquidity in the intermediate nodes. Is that correct?
That's correct, but it's not a technical limitation. It's a network effect limitation. So if we had the same conversation back in 2020, even sending a $500 transaction would be more iffy back then. So the fact that is increasing over time, that threshold. Now, nothing prevents, say, Cash App and Wallet Satoshi from opening up a $20 million equivalent channel with each other and sending $1 million Bitcoin transactions back and forth over it, if that's how they chose to settle. And that would work just as well with the limitation that's a hot wallet basically, so that they have to be careful about security. But there's no limit to what Lightning transactions can do, other than that there's only so much liquidity in the network at any given time, and only so much demand to send those big transactions. Because if I'm going to send you $50,000, that's something that we don't care if it gets there in 2 seconds or 20 minutes. We care more about the security of that transaction. And so that's something that's more prone to be done on chain. So there's not really demand to do that over the Lightning Network yet. Now, if we were talking 20 years in the future, and Bitcoin looks like FedWire, where like $1 quadrillion is like effectively settling over it per year, and all major banks are basically giant Lightning nodes, then sure, maybe there would be a bunch of $50,000 transactions happening in that world where 100 times more liquidity is stuffed onto Lightning. But that's not the world we live in today. But it is a world that's better along than we were 3 to 5 years ago.
So you seem to be pretty bullish on this Lightning network, and I think you like it because it's permissionless. Like there's nobody that runs it. It's not like like the proof of stake blockchains. Ultimately, there's a cabal, and you make this point in the book. Ultimately, all the proof of stake blockchains break down to a cabal of humans who can rewrite the ledger or censor it in any way that they see fit. Whereas I don't think Lightning is censorable in the same way, and I think that's one of the reasons why you like it. One of the reasons I don't like it. Let me put it this way: I came around a lot more to your way of thinking. I'm not all the way to where you are yet. It was better than I was expecting, and it's better than the last time I checked it out. That said, like if a transaction got lost in the middle somewhere, there's no block explorer. I'm used to block explorers, right? So I would be like, well, what happened to my transaction? There's no way I can go trace it. It's just sort of stuck in the system. Now, I wasn't read up on that, and it basically said Lightning would revert the transaction eventually, like within about a day or so. But I'm not sure if that's going to happen or not. So tell me why you're so bullish on it, and what's the answer to my question of I don't like the fact that there's no blockchain.
So I'm bullish on it as a middle layer for scaling. So I don't think that Bitcoin Lightning is a 100% solution of itself.
Yeah.
But when you have Bitcoin Lightning plus for smaller amounts, custodians, the custodial wallets, as well as I don't have time to get into it here, but Chalmy and eCash. So if you go back to even Nick Szabo's BitGold, he talked about something like Bitcoin being the foundation, and then Chalmy and eCash being the more private, fast-moving money on top of it. So now we have eCash on top of Lightning, which boosts privacy and other factors there. And so what I like Lightning because it's good for sender privacy. Now it is the case, as you point out, that not everybody wants privacy all the time. There are times where, for say accounting reasons or verification reasons, you don't want privacy. Maybe, for example, two well-established businesses don't want privacy. They want to be able to reconcile each other's ledgers. When they're carefully managing like Lightning nodes, or they're using a custodial node experience, or using a Lightning service provider, they can have various accounting software that reconciles that very strongly in various ways. But if someone's operating in a more cypherpunk way, they prefer at least the privacy option. So I think why I'm bullish on this whole stack of Bitcoin, Lightning, sometimes custodians, and Chalmy and eCash, as well as potentially other things, is because it's a giant choose your own adventure for exactly what you want. And like one example is I one of the current inventors or like appliers of eCash. So the idea itself was invented by David Chaum back in like the 80s. It was originally meant to be put on Fiat, but that's not really the best for that. It's better to plug it onto open source money. So now there's Fedimint and Cashew. These are two different Chalmy and eCash protocols that exist now. Callie's the inventor of Cashew. He's anonymous. He goes to conferences. He exists, but he purposely is one of those like cypherpunks where you don't know his name and you won't find his face online. And I can send him money without knowing his name, without knowing his business like legal identity. And yet I can still know it's him because, for example, Nostr gives us a self-organizing social graph. And so I can identify the real Kali there. I can send him, $1,000 worth of Lightning. He gets it. And, it's very private, which is kind of fascinating.
Yeah. It went to him without knowing all the information.
Yeah.
You don't really need to know.
Yeah. Which, and if I was Cash App and, Fidelity, and we had a Lightning channel, we wouldn't care about privacy. We want to care about auditability, by order of like way more important. And I can still look in my app and say, okay, I did this transaction and everything. But yeah, if I was sending massive amounts, I'd want to either use a very sophisticated method, or I'd want to use on chain. So that's why I love the whole stack. It's a pick your own adventure, and there's a lot more work to be done. But everything looks better than it looked 5 years ago.
Yeah, no, it's definitely better than what I thought it was going to be. So thank you for forcing me to have a look again.
Yeah, it's fun.
Okay, so that's I guess that's an hour. So that's our time together. It went by all too fast. Lynn Alden, thank you so much. You've been incredibly generous with your time. The book is Broken Money. I love it. You'll love it as well. Go out and buy it. My name is Mark Jeffrey. This has been Hash Rate. We'll see you all next time.